All right, folks, heading into 2026, all eyes on the Federal Reserve, which came to the rescue this year. I mean, despite a whole lot of internal opposition. But right now, few expect the Fed to cut. Certainly in January, the betting market's at just 87% that rates will remain unchanged. But my next guest is modeling for 4 cuts next year, 100 basis points. And by the way, in the first half of 2026, let's bring in QI Research CEO and Chief Strategist Danielle DiMartino booth. You got to walk us through this one. I mean, the Fed minutes are out.
Yep.
You know, didn't move the markets too much either way. But what are you seeing that maybe most are missing?
Well, what I'm seeing is companies continue to say, one after another, that the Dallas Fed manufacturing report came out yesterday, the service sector report came out today. They're all still saying we're in a layoff mode. We're going to continue firing people until we get our costs under control. And what people are not factoring in is that the unemployment rate rising faster than what's anticipated will prompt the Fed to move. And that's exactly what we're hearing, whether it's corporate America or whether we're hearing it from survey data.
You know, it's interesting about that. Just a couple of weeks ago, I had a great chart that shows historically how economists in general, but even at the Fed, are always wrong when it comes to unemployment. It moves up so much faster.
That's right.
It's the old, you know, gradually, then suddenly, and then they're always caught off guard. But you see that happening again.
We see it happening again. We see it happening again in real time. We know that October was a record month for layoffs. Those people are going to get severance for 6 to 9 months, but then it's going to all, like a pig coming through the python, boom, it's going to show up in the unemployment rate, just like what you're describing. That's going to take Fed policymakers by surprise.
Right.
But you know what? Last year we went in saying there were going to be 4 rate cuts all year. There were some people saying there would be 1 or 0. We got 3, so I'm comfortable with where we are with our call. Yesterday,
President Trump said, listen, the administration's considering suing the Fed, you know, the renovations at the building, $2.5 billion, maybe $3 billion. You know, to put it in proper context, though, they built a 60-story building for J.P. Morgan that cost $3 billion, right? But we know when he's really talking about, I think he feels like they've been grossly incompetent with respect to policy.
Right.
You know, it's no time.
That's his goal.
Yeah,
right?
yeah. I mean, you've talked about the idea that maybe Powell will stick around. He has to give up the chairmanship, but he doesn't have to leave the Fed. Could this kind of help nudge him out?
You know, I don't think so, because it certainly didn't help when President Truman was trying to nudge out Marinol Eccles. In fact, Eccles got his name on the building because he stayed. He stayed on behalf of Fed independence. And, you know, people are always like, I feel like the president's going to imminently announce a new name and who's going to be the next chair.
Right.
He can't make an announcement until he knows exactly what Powell's plans are going to be. Will Powell decide to stay until January of 2028? Powell doesn't have to say a word until May.
You talked early in the year before anyone, and you started noticing these upticks in bankruptcies, and they're across, you know, industries, right? Industrials, consumer discretionary, healthcare. Again, how much does the Fed take something like that into account?
The Fed should be taking this into account. We're at a 15-year high in corporate bankruptcies. We had a $2.4 billion porta potty company file yesterday in New Jersey that was out of Massachusetts. These are not small bankruptcies, Charles. They're large. And for the Fed, what their eye is going to be on is whether the credit cycle, as it continues to accelerate, ends up causing bond issuance, bond sales to slow. That was a huge boogeyman for Jay Powell in 2018. So if he sees bond sales start to slow down when there's this wall of refinancing to get done, that's going to make Fed policymakers very nervous. You know, I'm from Jersey, so anytime a porta potty business goes bankrupt, it's a big deal. For Cousin Eddie, too. Let's talk about the report you put out. 2026, a year U.S. housing capitulates. What does that mean? We're seeing so many more sellers than buyers. We are seeing prices come down in a majority of U.S. cities. More importantly, Charles, we're seeing rejections. So people are applying to buy a home, but their application's being rejected. We're seeing cancellations, and we're seeing home builders, as you well know, you follow the stock market day and night. We're seeing profit margins for home builders get absolutely eviscerated. That's telling us that affordability is not where it needs to be. It doesn't matter where mortgage rates are, Charles, because the unemployment rate rising always trumps a falling mortgage rate. Let's talk about the key risk that you wrote about. And, you know, so this has been issuance. Certainly, we've been doing a lot more T-bills. And I think you talked about maybe the inability to issue. What would cause that? You know, what would be a hiccup that would cause the Treasury not to be able to issue or meet their goals? Well, so I was actually referring to corporate America and their issuance. I mean, if T-bills aren't able to be issued, Charles, we can just... That's what that's like Armageddon. But corporate hasn't had a problem. Corporate has had no problem at all. We've had clear sailing, but we have seen a lot of leverage get questioned in the private leverage space, the private debt space, BDC companies this year, they've come under pressure.
Right.
And we know that the AI trade now is being backed not by cash flow and profits, but by leverage. So at some point, we're going to hit this critical mass where they're going to say, you know what? 13 trillion, 14 trillion. At some point, you do get the pushback, and we have started to see glimmers of liquidity begin to dry up in this market, Charles. That's what I've got my eye on, because again, the Fed will pay attention to any signs of liquidity drying up.
And we've seen it in those publicly traded PE stocks as well. Hey, just less than 30 seconds ago, one thing that made me feel a little better, though, you're saying that, at least from the stock market's point of view, this juggernaut of passive investing kind of puts a bid under the market.
It's certain. Look, the end of November, that's what we saw. Flows came in because it's automated. Every 2 weeks, people get paid. Every 2 weeks, they automatically buy. What do they buy the most of? NVIDIA. They buy the most of the largest market cap stocks, but they're not doing the buying. It's just automated in nature. And so this is a phenomena that I think is underappreciated, that underpins the market, and it's very structured. Mike Green's done some great work on this, and right now it looks like the flows still no.
I keep telling people the fix is in. Take advantage of it while you can.
Happy New Year,
Great
Charles.
seeing you so much.